Well, hello everyone, and welcome to our webinar on the fundamentals of an entity structure. I hope today's session will be highly educational for you as I'm trying to share with you how you can maximize the use of an entity while also reducing any potential risks. My name is Nicole Fry. I am a project manager at Succession Resource Group. For those of you who don't know us, we are a business consulting firm and are mainly working with financial advisors, but also with other service professionals. Our services include business valuations and merger and acquisition support, and then all kinds of other elements that help you grow and protect your practice. And that includes entity formation and restructuring, the topic of today, and also employment resources. That includes employment contracts and compensation models. And we help advisors set up equity sharing plans for internal people to help them grow into the new generation owners or create certain incentives. And we set up death and disability as well as succession plans. For today's agenda, as I said, I want this to be educational. So we will start off with some of the common reasons to form an entity. And then I want to describe some of the more common entity types to you and how to classify them. One of the big topics always that I have with clients is how do I maintain this entity that I now formed to make sure I can maximize its use and I can reduce my risks. And then last but not least, I will share with you some of the potential risks. A lot of them contain some industry specific nuances. So especially if you have a broker-dealer affiliation, this will be highly educational for you, I believe. Before we start off, I want to pull up the first poll question here to get an idea. What was your main objective when you formed an entity, if you have one? And if you don't have an entity currently, what would your main objective be at that point? This poll question should show up on your screen. And while we're waiting for those results to come in, I just want to take care of a few housekeeping items for today. If you have any questions, please feel free to post them in the Q&A section. You should see a little menu bar up on your screen where you can post your questions. And if we have some time at the end of the session, I will try to get through as many questions as possible. And for those questions that haven't been answered, we will reach out if we have your name and contact information and provide you with an answer. The recording of the session will be available by Monday next week. It includes a link to the recording as well as a link to schedule a 30-minute free consult call. So if you have additional questions or you want to find out what it is that we can do to help you with your entity, please feel free to schedule that free initial consultation. And then last but not least, if there are technical issues, hopefully we won't have any issues today, but please don't worry about it. We will record the session and then you will have that link by Monday so that you can still watch this webinar. All right, the poll results are in and it looks like the main objective was to enjoy that personal liability protection that a formal entity provides. Tax savings is the next option here. I do hear that a lot. And then the recommendation by a CPA or attorney, that comes up as well quite a bit with our clients. All right, so let's dive into our first topic here, the reasons to form an entity, and some of which you already mentioned today, which is the personal liability protection. So that was your objective number one, and it is definitely something I always bring up with clients who come to us to form an entity. As you know, as you start your business, you put insurance in place, but that only covers what you actually do with your clients. And as business owners, you have a whole other array of potential risk exposure there. As you put in place business insurance, just like with any other insurance, you have insurance policy limits, and there might be some coverage gaps. What I do always bring up with our clients is to, for example, think about what your exposure is as you operate a business together with a business partner without having that formal entity in place. A lot of times that would open you up to liability for the acts that were committed by that partner. And the same with business debt, that would also not be covered by your business insurance. Sometimes that debt requires you to sign a personal guarantee. So again, you would be on the hook personally for that debt. But some of the loans might not require that. So you could avoid it by having that loan with your formal entity. Equity sharing was also one of the reasons that you mentioned in the poll why you wanted to set up a formal entity. Having that formal entity allows you to easily share partial equity. It is easy to enumerate what someone would own in terms of maybe shares or membership units, and it would be easy to calculate what the value is of that equity. So we do see that quite a lot, that clients want to set up entities so they can easily engage in mergers. Those can be traditional mergers where two parties would come together, form an entity, and put all their assets and resources into that entity. Or it could be what we see more commonly happen lately. It could be an equity swap. So this is where you would already operate your business and you have a formal entity and someone wants to join you. That person brings along a book of business and wants to exchange that for ownership in your company. So we call that equity swap. Your CPA might say that's a capital contribution, and in exchange, that person would receive ownership. Equity sharing also plays a role if you want to engage in internal succession plans. Again, that makes it a little easier to figure out how much do you want to sell to an internal team member, for example. I did put here on the list equity sharing plans, so it could be equity grant plans that could be part of your succession plan, or equity purchase plans. And last but not least, I did mention here deferred compensation plans. That is not a true equity sharing plan. However, deferred compensation plans, you might know them as phantom equity plans or equity appreciation rights plans. They track with the value of real equity. So it will be important if you wanted to set something like this up to have a formal entity so it's really easy to calculate what that value is of the equity. One item that you might have not thought about that is also a very good element of having a formal entity, and that is putting in place a more structured business. The entity often requires you to put in place comprehensive governance documents. They define the decision-making process and they clearly outline the rights and responsibilities of all of the parties involved. And they include a process for succession planning or dissolution purposes. So sometimes informal partnerships tend to not have these documents in place so that all of these items are open for negotiation and discussion when we have an emergency, for example, or when the parties are not getting along and now need some guidance. So it's definitely important to have that in place, especially if you operate with business partners. Formal entities also promote that financial records are updated and organized. We all would like to have that for our businesses, whether we are a sole proprietor or a formal entity. However, because there are some transparency and disclosure requirements, especially as you operate with partners, formal entity structures tend to make sure that those financial records are always up to date. And a lot of you might already take advantage of the services of a professional here, which again makes sure that they're always current and that you can also reduce errors by using someone who does that on a daily basis. Formal entities also help with the deliberate assignment of roles and responsibilities. That discussion comes up when you want to decide what kind of officers do we want to put in place, what are the roles and responsibilities of the officers, And do we need to assign a certain compensation level for those roles? So we have that conversation all the time when we form an entity with clients to make sure that they account for that. Since a lot of times you move away from just servicing your clients, now you're taking on roles like the role of a manager or an executive. And it's important to incentivize someone to also spend time on that role, and therefore you would allocate some compensation to that role. And last but not least, the tax savings component. So this really just applies if you made the S Corp election, or for some of you, if you have a C Corp, there is some tax savings there. However, the C Corp also opens you up to double taxation, so I don't see that a lot in this industry. So the S Corp election also opens you up to a greater IRS audit risk due to that tax savings component. And I will talk about that a little bit more here later on as we start the last section of this presentation on potential risks. The S Corp election also opens you up to some restrictions. So there are some objectives you might have, for example, equity sharing, that might be restricted if you are operating an S Corp for your business. I will share some more information on that later. The tax savings component of an S Corp is typically limited to the Medicare taxes, and I will explain why. If you do operate an S Corp and you're an active owner, the IRS wants to make sure you pay yourself a reasonable salary. And that reasonable salary amount is typically something that you would pay someone who were to perform the role you're currently performing. Most of our clients end up around the Social Security taxable wage base. I believe that's around $140,000 at this point. So they end up somewhere there, and they won't save any Social Security taxes because of that, because their W-2 compensation already maxes that out. So the profit distributions then are subject to ordinary income taxes, and the only component you would be saving is the Medicare taxes on the profit distributions. And the Medicare taxes right now still are 2.9%. If you are a higher income earner, you might be subject to an additional Medicare tax of 0.9%. For some of our clients, that really adds up and it makes it worthwhile having the S Corp. But for others, it really is a decision where they have to balance, are the savings worth the effort and the risk to maintain that S Corp? Now it's time to bring up poll number 2 to find out what type of entity structure are you currently operating. Let me launch question number 2. While you're entering your results here, I want to share with you one of the myths that I constantly hear from people who want to have an entity, but they always tell me I can't have an entity because they have a broker-dealer affiliation and they believe for compliance reasons or because of the IRS audit risk, they cannot have an entity. The answer is you can have an entity. You just have to really make sure you're buttoned up, that you make decisions with full information and that you weigh your risks. And those risks can be reduced, and I will share with you later how. So it looks like the limited liability company and the S Corp are pretty close. Most of you have an S Corp, but we still have quite a few sole proprietorships out there. So I'm hoping this will give you some good information today to encourage you to have a formal entity in order to reduce your personal liability exposure. Now, I want to share with you some more information concerning the common entity types, and I want to take it a step back and really start with the basics here because there is often some confusion with respect to the classification of entities. So when you first decide to form an entity, you will have to decide what type of basic legal form are you choosing. And I listed the most common examples here, which is the limited liability company or a corporation. The basic legal form determines what you're submitting to the state. For example, are you filing articles of incorporation or are you filing articles of organization, which are for the LLC? And it also determines how this entity is governed, whether that's by state law or do you have agreements in place. So it's really important to understand that that is your basic legal form, and that determines what type of terminology we're also using, whether we have a member or a shareholder, whether we have membership units or shares of stock. So that's the first decision you'll have to make. And then the second decision is, how do I want this entity to be taxed? So if you have a limited liability company, you can choose to have it taxed as a partnership if it has more than one owner, or you can choose to have that taxed as an S corp. And the same with the corporation, you can keep it the way it is, and then it is taxed as a C corp, or you can make the S corp election, and now you have an S corp. Just because the limited liability company has the S corp election does not turn that into a corporation. So as I stated earlier, you still have members and membership units and an operating agreement. So all of that stays the same. When we talk about the entity's tax status, it is important to understand the effect of that tax status. The LLCs, if they're taxed as a partnership, they're a pass-through entity. That means the taxation occurs on the owner level. All of the income that the owner receives is subject to ordinary income taxes and employment taxes. So there are no tax savings there, which, if that's what you have in place, will reduce your risk of an IRS audit significantly because there are no tax savings. If you make the S corp election, whether that's for an LLC or a corporation, and you're actively involved in managing this entity, you are required to pay yourself a reasonable W-2 salary. So that is subject to income taxes and employment taxes. And then any profits distributed out of this entity is only subject to ordinary income taxes. So no employment taxes on that. But as I mentioned earlier, for most of you, that will only save you the Medicare taxes, because we really have to make sure you pay yourself a reasonable W-2 salary. For the C corporations, again, we don't see them a whole lot. I mentioned there's double taxation in place, which means taxes are due on the entity level as well as the shareholder level. Active owners receive a W-2 salary, and then that salary is subject to employment taxes as well, just like any other employee. And then dividends to be distributed out, they are not subject to those employment taxes. I thought it would be helpful to compare the most common entity types for you, the pros and cons of each, just because that decision always comes up when we start a project here at SRG. The S corporation definitely has that benefit that you do have the tax savings. However, it also opens you up to a greater audit risk because of those savings. It does provide that personal liability protection that you're looking for. And it also gives you that structured operational structure so that you can define and regulate the ownership and the rights and responsibilities of all the parties in that company. So the limited liability company provides that as well. However, the limited liability company is a lot more flexible in terms of accomplishing mergers and acquisitions. With a limited liability company, you can easily integrate another partner in exchange for their book of business. And I say book of business, what I'm really referring to here is their personal goodwill. So someone can contribute personal goodwill to an entity. It is an asset, as we know, because they're quite high multiples out there to pay for that personal goodwill in this industry. So someone can contribute that personal goodwill to an entity in exchange for ownership. In an LLC, that can be done without any negative tax consequences. However, in an S Corp, that triggers certain tax rules, so the person contributing that book might incur a tax liability. So that's something important to keep in mind if you have some expansion or merger plans out there, that could trigger some tax consequences to the person joining you. Now, a favorite topic, entity maintenance. I'm sure you don't want to spend too much time personally on this. You would rather like to outsource that. And if you do have that option, I highly recommend it. So you can do what you do best, and that's serving your clients and growing your business. However, it is an important topic. And in my world, entity maintenance always starts with the decision makers. Who the decision makers are depends on how your entity is structured and what type of entity you have. With a corporation, it might be familiar to you. We typically deal with the shareholders who vote for the directors, and then the directors select the officers. The shareholders only have a few decisions on the corporate level, and they pertain to vital changes of the corporation that could affect the shareholders. For example, mergers. And then the board of directors makes all of the high-level decisions for that corporation, while the officers make all the operations related decisions. So they make all the day-to-day decisions. In an LLC, you are more flexible, and I put the most common structures here. The easiest one is the member managed LLC, where all of the members come together and make all of the decisions, provided the members have voting rights. So I will talk about that here on the next slide. So those decisions might require different percentages of approval. For example, you might have some decisions that require unanimous consent. Others require supermajority, but the bulk of the decisions will probably require a simple majority. So it's really easy to make those decisions. You will not come up to a deadlock. That way you can operate the entity efficiently and effectively. The other option here on the very left side is the manager managed LLC. We see that typically put in place if the founders want to retain a higher level of control, or if we have a core group of people coming together and they are pursuing an entity type that allows them to add a lot of members down the road, but they want to, again, retain control over the operations. So this entity type requires that the members make all essential entity related decisions, including voting for the managers, and then the managers make all of the operations related decisions. I mentioned that decision making requires that an owner has voting rights, and this is where the ownership classes come in. For LLCs taxed as a partnership, you have the flexibility to create as many ownership classes as you want and allowed by law. The corporation, the C corporation, is similar. You have restrictions, however, on ownership classes with respect to S corporations. So here we have to be careful what we put in place. The ownership classes typically pertain to three particular rights. And those rights are the voting rights, so the right to make a decision, the profit rights, and liquidation rights. Liquidation rights means that upon sale of your ownership interest, you are entitled to receive the value for your interest. So for LLCs, for example, you can put all three of these ownership classes in place, including the voting units, non-voting units, and liquidation units. And each of them includes a certain set of rights, with the voting rights or voting units having all three rights, and then the liquidation units only having those liquidation rights. I get that question a lot from advisors who engage with us. When would I be using those liquidation shares or units? they're actually a very useful tool in your toolbox, especially if you pursue acquisitions. There are some sellers out there, they're not ready to retire, but they would be willing to take some chips off the table, sell their book now, and then still contribute to maybe your business. So you could offer them a portion of the purchase price in the form of cash or a seller finance note, and then another portion in the form of liquidation shares. And if your business is prone to grow, then the seller will receive a greater value than what those shares were worth initially when they were granted. So it's a win-win for both parties. The seller will contribute to your business to help it grow. You get to acquire that book, and in turn, the seller receives a higher value at the end when he or she is willing to sell those liquidation shares. Entity maintenance should also include your entity documents. So for those of you who have an entity, it would be worthwhile checking out your documents to make sure they're in place, meaning they're also signed. We do have quite a few folks come to us with the entity documents, but they've never been signed. So pretty much it's just a draft. It's not an executed document. If you have an entity in place, you will have those articles. The state will require that. That's ultimately what you submit. And then all the other documents are similar, except for the operating agreement for the LLC and the bylaws for the corporation. The corporation is considered a creature of statute, so there's not a whole lot that you can negotiate and customize. And so your bylaws would look pretty boilerplate because they just regurgitate the statute. But the LLC gives you an option to really customize and create a unique agreement between all of the owners and the entity by creating an operating agreement that meets your needs. A lot of times those customizations pertain to how profits are paid out, for example, or how decisions are made. When it comes to entity maintenance, the initial work really lies in making sure it is established properly, you have all the documents in place initially, and then once that's done, you have some annual requirements that you have to meet. Most states require you to file an annual report, and that is to update the state to make sure the name of the entity, address, registered agent, all of that is still correct. And the state obviously still wants a filing fee too. I recommend always that parties get together prior to filing that annual report to have the annual meeting. A good time frame here is about 1 month prior to your report being due with the state. And at that annual meeting, you will go through everything that you would have to update the state of, for example, the address, or if you want to change the name, or your registered agent. But then also go through a list of items that require a decision of the owners. And looking at your operating agreement should give you some guidance with respect to what the decisions require, whether you need unanimous consent or a supermajority or a simple majority. What you'd also want to make sure is that your financials and tax filings are updated. If you're utilizing a professional, that's great. They will make sure you always follow all the standard procedures and standard accounting rules. You also want to make sure on an annual basis, you review the owner's roles and their compensation and make sure you assign any new roles, or maybe you have to shift some things around. And then ultimately you would capture those decisions in formal consent minutes. And they don't need to follow all the legal standards. Something is better than nothing. You can probably Google most of them and then just make them your own and make them fit your needs. But I recommend having a record in place so you can show who actually voted on this decision. Did we have the appropriate voting percentage? Now I want to pull up the next poll question to find out, after you've heard all of these entity maintenance requirements, how well do you think you're currently maintaining your entity? And while we're waiting for those results, again, I just want to recommend, if you think you're too busy to maintain your entity, please consider outsourcing that to your CPA or attorney, or maybe you have an operations person and it just takes a little bit of training for a year up until they're up and running. And at this point, I also want to mention that SRG will be rolling out an entity maintenance program for advisors who want to outsource that type of responsibility. So please feel free, once we have that rolled out, and you will receive notice from us if you contact us to let us know if you're interested. Great, it looks like everyone thinks they're maintaining their entity somewhat well, but there's still a 17% here that are saying we're not doing so well. So please feel free to reach out if you have any questions. Our last topic pertains to risk mitigation, and some of this is really focused on industry nuances, especially if you have a broker-dealer affiliation. This will be very useful to you. But before I dive into industry-specific nuances, I want to make sure we focus on your long-term goals. So when you set up an entity, it is really important to picture where you want to be in 10 or maybe 20 years. What does your team look like? How large is your practice? What kind of services do you want to provide to clients? What are your main objectives? Do you want to expand for mergers maybe, or do you want to capture some of those tax savings? So as you form and set up your entity structure, those long-term goals will give you plenty of guidance. I did put here some of those objectives on the screen, and it depends on what you're prioritizing. You might choose the LLC tax as a partnership over an S Corp, for example. So it really depends on your priorities here. At this point, I want to show you an entity structure that has been very popular in the last year, and that is because advisors who come to us express the wish to maintain both. They want to be flexible. They want to make sure they can expand through mergers and acquisitions. However, they also want to ensure that there's a certain tax savings component involved. So quite a few opt into this more comprehensive or complex structure that you see here up on the screen. The way this works is you would form an LLC that is taxed as a partnership, and that LLC is your main operating entity. It would hold 100% of your business value. I talked earlier about contributing your personal goodwill to this LLC. Your personal goodwill is your main business asset, so it would be owned by the LLC. And then all of the revenue and all of the expenses would also be held in that LLC. Now, that gives you ultimate flexibility because now people can merge in without having negative tax consequences. You can decide how you want to distribute profits out rather than an S Corp where you're tied to an ownership percentage. The LLC gives you flexibility, for example, to distribute profits based on someone's ownership, someone's production. The LLC, instead of being owned by you personally, is owned by single owner S Corps. So that's that special nuance here. So rather than you being the owner of the LLC membership interest, it will be an S Corp you set up, and you're the only owner in that S Corp. So the way this would work is the revenue flows into the LLC. You pay all of your operating expenses here, and then the profits would flow out into your S Corp. You would make pay a reasonable salary to yourself, And you might have some individual expenses that you don't want to lump into the LLC with all your other partners. And then any profits remaining will be distributed out on a K1, and that's where you have those tax savings. So a little bit more complex, however, it gives you the best of both worlds. Now, when I talk about the revenue going into the LLC, this is where we have the risk number 2 that I listed on that previous summary, which pertains to an IRS audit risk. For anyone here in the audience who operates an RA, that risk does not pertain to you particularly. Obviously, there's always an IRS audit risk for anyone out there, but you don't have a heightened risk because of how you operate your company. The RA setting is in a way that the entity actually contracts with the clients and the clients pay the entity directly. So that's a nuance we don't have for advisors who are affiliated with a broker-dealer. Broker-dealers only pay the licensed advisor rather than the entity directly. There are a couple of broker-dealers out there, as far as we know, who pay at least the advisory fees directly to the entity, but most of them don't. So for advisors with a broker-dealer affiliation, you will have to figure out a way to get that revenue into the entity, and we can help with that in collaboration with your CPA. Before I dive into those solutions, I just want to share a little bit more information why this type of setup increases your audit risk. So in order to get revenue to your entity, you would have to figure out a mechanism, whether that is assigning or nominating that income to the entity or paying for certain services. So those are some of those solutions. When it comes to the assignment of revenue, which is what most of you would want to do because it's the easiest way to accomplish your goals, and it's the easiest way to have all of the revenue into that in that entity. It violates a doctrine that the IRS is following, and that doctrine is called the fruit in the tree. And what it means is if you are the earner of the income, the IRS will make you or has that requirement that you are also the taxpayer. So the earner should be the taxpayer. Now, by assigning that income, you are no longer the taxpayer on that level. You are now having the entity report the income, and we need justification for that. The one advisor who didn't do that was Ryan Fleischer. So I don't know if you've heard of that tax court case. Ryan Fleischer was an LPL advisor who operated a single owner S Corp. And as he started his company, he started out with a somewhat low salary, but then his company or his business grew and his salary remained pretty much the same, but his profit distributions increased substantially. So when he experienced an audit, the auditor said, there's no reasonable salary. What is happening here? And ultimately found that there's no reason for the S Corp to exist other than for tax avoidance purposes. So obviously we want to avoid that for you because Ryan Fleischer had to pay back taxes and stiff penalties. And in order for you to reduce your risk, you can consider one of these two solutions. The solution that would work best for you depends on whether or not you operate as a single owner or if you have partners in the entity. For businesses that have more than one owner, we recommend implementing this revenue pass-through model that you see up on the screen. It looks fairly complicated, but basically what it means is the broker-dealer would pay the licensed owner directly, and then that licensed owner would be obligated to assign or nominate that income to the entity. And then the entity would distribute that back out to the owners, and the owners would then make those tax payments. There are three components that need to be put in place in order to reduce your audit risk here. And one is you have to be paid a reasonable salary if you're an active owner. And I already talked about that, what the potential amounts would be. It depends on your business size and what your role is in the business. You also have to show that there's a contractual basis for that assignment of the revenue. Now, we can set up contracts any day. That is not the problem here. I think the third component is really what most folks are struggling with, and that is making sure they can substantiate that the person receiving the revenue is not in sole control of that revenue. And this is where your documentation comes in place, and having other partners in your company that also have decision-making power over that assignment. So it really needs to be addressed in your documentation and your voting provisions to make sure you can substantiate that you alone did not generate or control that revenue. It is actually an effort of the entire team. If you operate a single owner S Corp, our recommendation is that you basically operate two businesses. As the financial advisor, you would remain a sole proprietor. And then you have this S Corp that provides practice management services to advisors like you. The IRS won't judge whether or not this is a successful business model. If you remain the only client, then so be it. We have some clients that actually expanded this model and really utilized it to its fullest potential and use that S Corp to provide practice management services to some peers. But the way this would work is this S Corp would provide services to you, turnkey services, and in exchange charge you a fee. And because the S Corp is meant to generate a profit, a lot of your revenue would be paid over in exchange for the services, so that the S Corp would have profits left to be distributed to you as the single owner. Now, on the practical side, what that looks like is you receive revenue from your broker dealer. You get that 1099. It shows up on your Schedule C, and then a large portion of that is then reported as an expense, because that's what you will pay over to that S Corp in exchange for services. So you will still have some income left on your Schedule C that then is subject to income and employment taxes. Now, the revenue that got paid over to the S Corp will be used to pay for your expenses. You should receive a smaller salary for your position as a general manager. And we have to keep in mind here that that position is a part-time position, because you also still function as a financial advisor. So you can't dedicate full-time services to this S Corp. So typically that salary is around 40 to 50,000. It depends on your CPA's comfort level there. And so you will pay employment taxes on that, as well as ordinary income taxes. But ideally, you would have profits left that will be distributed out, and that's where you have that tax savings component. Compliance is also something that a lot of folks raise as a concern, because you're putting securities related income into an entity. Really what we have to watch out for is the redistribution of securities related income. And there are ways to make sure that you can avoid any compliance violations there. As a start, I would recommend revisiting your compensation plans. A lot of times in this industry, we like to compensate our employees based on their production. So if the entity is an employer, I recommend reviewing that compensation model and making sure that you don't have GDC-based compensation in place, because that could potentially violate that redistribution rule, depending on what your revenue is comprised of. So if you're mainly advisory fees, you might not have to worry too much about that. But if you have quite a substantial portion being commissions-based revenue, there are alternative comp plans that you can put in place that result in similar incentives, but will reduce your compliance risks. The first item here on this list is not directly related to compliance, because you can operate your business as the sole owner. Obviously, it's just you then who has the required licenses. But if you want to provide for continuity, it would be important then to have some sort of agreement in place with a peer to continue your legacy. If you're thinking about maybe an internal succession or continuity plan, making sure whoever takes over the business also has the required licenses. I do get that question quite a bit, if you can grant equity to a non-licensed team member. And the answer is yes, but you have to be aware that in the event something were to happen to you and you're the only owner with the required licenses, the business might not be able to continue. So it kind of depends on the business type that you have and what your requirements are. Now I want to pull up the last poll to see how well you're managing these types of risks now that we've gone over those risks. Please feel free to submit your answer here. And while we wait for those results to come in, I want to mention some of the best practices to round out our presentation here for today. You heard me say quite often to keep long-term goals in mind as you make decisions for your organizational structure. Those long-term goals really decide how you want to build your team, what entity type works best, what tax status works best. And what you're doing when you keep your long-term goals in mind is you engage in strategic organizational planning. So you really make sure that all of the business components are geared towards pursuing those long-term goals. So again, that could pertain to your employment strategies, your recruiting strategies, acquisition, mergers. Any of those elements should all be lined up to pursue your long-term goals. And then to forego short-term awards for long-term rewards is always something I mention. If your CPA recommends that you should put in place an S Corp to provide some tax savings to you, the question should really be, is this something that still benefits me and my business in 5 or 10 years, depending on what I'm trying to build? The second item here is to keep your house organized. I talked about entity maintenance. It really helps you reduce risk. It gives you guidance on how to manage and operate this company. Keeping your financials updated shows you what your strengths and weaknesses could be. So that's always important to maintain that on a frequent basis. And looking at the poll results, most of you think you're managing those risks pretty well or somewhat well. Some of you say not well. If you do have any questions for us, please feel free to reach out. Please utilize that consult link that you receive next week. If you have any concerns and you do need help, please reach out to professionals. They can help you reduce your risk and also take some of that workload off of your plate. I hear that a lot, that our advisor clients are very busy growing their practice and managing it. And so this entity maintenance can turn into a minutia and it can be cumbersome. However, if you have everything organized and in place, it should be doable, especially if you have a team member to help you with that. However, if you do want our help, making sure you're completely buttoned up, SRG can provide that consulting needed. It is very educational. We share a lot of information with our clients to help them make decisions with full information. If you don't have an entity yet, and I know there were quite a few sole proprietors, we can help you set that up. We complete the state filing for you and obtain your federal identification number. If you want to make the S election, we can set up that form for you. And ultimately, we make sure all of those documents are in place, they're industry specific and address all of these risks that we talked about today. And we will help you implement them. So that's that initial organizational meeting support that you see here on the list. It is very important so that you don't come back to anybody in a few years with documents that are not signed. We will make sure that they are signed and that they are organized in a binder so that you have them for future use. So that's it for today's presentation. There are a few questions that I would like to answer if we have sufficient time. Adam posted a question. When I first started, we operated inside a BD and I established a 100% single member LLC. Recently, we established an SEC registered RA and I created a separate 100% single member LLC for the RA functions. Both entities operate under the same DBA. Adam, that is something that quite a few advisors do. So depending on, for example, if you want to separate your assets from your liability, or if you have maybe real estate in an LLC, you might have more than one entity. The single member LLC, if it doesn't have the S Corp election, for anyone out here, means it is disregarded from an IRS standpoint, which means that you don't have that audit risk that we talked about, other than everyone else's regular audit risk, because all of your financial information are still captured on your Schedule C. Oh, I see, Adam, you posted then another question. Is there a better structure, a third umbrella entity, which sits on top of the BD entity and the RA entity? So that can be pretty complicated, and it does need to, we need to look at what does that top entity do. So usually the RA, as I mentioned earlier, it has all of the client contracts and the revenue. And therefore is the entity that would be considered having the value. So we would have to discuss what it is that you're trying to accomplish to make sure that that top entity makes sense, but holding companies are quite common, so it could be done. Wilson posted, if IBD does allow advisory fees to be paid to your entity, does that technically count as an assignment of that compensation, or does that help bypass this issue? And then the only work is figuring out how to transfer commission compensation from your name to your entity. It's the latter, Wilson. So if your broker-dealer pays advisory fees directly to your entity, it is not considered an assignment. This is actually really helping out reducing your risk, because if the majority of your revenue is advisory fees and it's already in the entity, we just have a small portion that needs to be assigned. So again, that really reduces your risk. Perfect. So I think we got all of the questions answered. Once you digest the information, if you do have more questions following this presentation, or once you see the recording, please don't hesitate to reach out to us. We will be happy to answer any of your questions. And our contact information is here. Thank you so much for joining us today. I really appreciate it. And I hope we will have the opportunity to talk to you soon. Thank you. Bye-bye.